Hey everybody, we are going to talk about Bill Ackman's latest offer to, quote, create the modern day Berkshire Hathaway. Before we dive in, Tyler Crowe is joining me. We have a lot to talk about, but before we get started, please take a minute, check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It is the best way to support this work we're doing. The link's also in the description, so check out fool.com/Frankel. All right, so just to kind of bring everyone up to speed, a few weeks ago, or actually a few months ago, Bill Ackman came out and said was interested in pursuing a deal to acquire the remainder of Howard Hughes Corporation or Howard Hughes Holdings that he didn't already own. It's by percentage stake, it's the largest stock in Ackman's portfolio. He owns a 37% stake in Howard Hughes Corporation now. They're the real estate developer of master plan communities. So fast forward to a few weeks ago, Ackman made an offer that was kind of unconventional, I guess you would say. In true Ackman style, it was very complicated. It took a 14-page explainer document to even get the point across. But the basic idea was that Ackman was going to acquire a majority stake. He offered $85 a share, which was a slight premium over where it was trading. And he would be the majority owner. He would become the CEO of Howard Hughes Holdings. Howard Hughes Corporation, the real estate business, would continue to operate independently. And then he would gradually acquire majority stakes or entire businesses and create, as he referred to it, a modern day Berkshire Hathaway. Now, the offer has been updated once again. Ackman is no longer seeking a majority stake. He now wants a 48% ownership stake. So that the significance of that is that the transaction can close very quickly. It's a lot harder to get a majority stake pushed through than it is to just continue to be a minority shareholder. So now it can close in weeks, not 6 months or so. And he's not acquiring shares in the open market. He's buying newly created shares, 10 million of them, and he upped the offer by $5 a share to $90. This would create a $900 million cash infusion for the company that could kind of kickstart the strategy to become the Berkshire Hathaway. And some parts of the deal stayed the same. And this is, I think, what Tyler and I are really going to talk about a lot. Part of the deal is that Pershing Square, the hedge fund Ackman runs, would give its resources to Howard Hughes to raise capital, evaluate investment opportunities, whatever, in exchange for a 1.5% management fee based on the equity market capitalization of Howard Hughes Holdings. That would be payable in quarterly installments, but it would be a yearly percentage. And it's the same fee that Pershing Square charges investors. There wouldn't be a performance fee component. This is not a very Berkshire thing to do, is kind of the big argument that I have against it. It's not unheard of. Privately managed REITs tend to have fees like this. All the Brookfield subsidiaries, if you want a public example, actually have higher effective fees. Brookfield Infrastructure Partners, for example, pays a 1.25%, so 1.25% management fee each year, but that's based on total capitalization, so it includes debt. So it actually turns out to be more than 1.5% of the equity market cap. So not totally unheard of, but if you are a 48% stakeholder and you can actually turn this into a Berkshire Hathaway, in my mind, you're going to make enough money in that way. You don't need to take a 1.5% fee off the top. I'll stop rambling. I'll turn it over to Tyler. I know Tyler has some thoughts on this. I'm the one who is a Howard Hughes shareholder, by the way. Tyler, what do you think?
Well, I have this sudden urge to go defending Warren Buffett because in some of the comments that Bill Ackman made in this was like, we're going to build a modern day Berkshire Hathaway and do it way smarter than doing something stupid like a dying textile company. We're going to own, things that are going to become the next great American cities, which sure, fine. But there's just like that. The thing that I just keep looking at when I see I guess the flaw in this is like I guess the general concept being is that Warren Buffett used the textile business of Berkshire Hathaway to create his to invest in other businesses, right? Use the cash that Berkshire Hathaway threw off, kind of, in a derogatory sense, siphoning off money from that business to invest in other places. This is kind of the same idea, right? Pershing Square is going to siphon off money from Howard Hughes to, build a Berkshire Hathaway, I guess. Whether I'm not 100% certain where the Berkshire Hathaway gets built then, because if you're siphoning off the cash away from Howard Hughes, is it not being built as the conglomerate at Howard Hughes? It's being built at Pershing Square, which is a private. It's not publicly traded, so that's a little strange to me. But there is a key difference here, and this is my opinion. Berkshire Hathaway was a cigar butt business. This was a business that, the writing was on the wall that textiles in the United States was moving overseas. It was cheaper there, and there wasn't a lot of room for the textile industry, especially in New England, where much of Berkshire Hathaway's assets were. And so the idea being is like it was throwing off a lot of cash, and there was no place to invest it effectively in the business and get a future return because they knew the business was dying. So we're going to siphon off the cash into a productive asset elsewhere. Howard Hughes, the business itself today, is not throwing off excess cash. This is a business that is still taking in cash for the development of its master plan communities. It needs to bring in capital through debt. It needs to bring in capital through equity to continue to build what they want to build. So there is no, in like management's view, the best place to put the money in Howard Hughes is into Howard Hughes specifically, into building out these. That is where they think their best place to allocate capital is today. And so if you are siphoning off money from Howard Hughes in the form of a management fee, you are saying that you're kind of starving the company for a little bit of capital, which is something that they seem to desperately need. I mean, there's that massive deal that they did just outside of Phoenix for another master plan community, which I think in terms of size is much, much bigger than any of the other master plan communities that they have, elected to make in previous years. The amount of money that is going to have to go into a development like that is substantial. And so I get very tentative at the idea of Howard Hughes requiring so much capital and then having Pershing Square siphon it off because they say they can manage it better. I'm not sure precisely with like this massive development that you have, like what are the other capital and things that you are going to, capital acquisition, expenditures, acquisitions, whatever you will, that you are going to pursue that Pershing Square can do better that aren't already in your development pipeline. There's just so many questions to me about the mechanics of how this works, and to compare that to what Berkshire Hathaway did with the textile business, I think is being a little too glib with what was done there, and I really have my doubts. I can't see how this is as effective as Bill Ackman purports it to be.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.